All right, today we're diving into what is, without a doubt, the single most important number in all of commercial real estate. I mean, this one metric, it drives pretty much every major decision. We're talking everything from figuring out the value of a skyscraper to getting a loan for a new apartment building. So what is this magic number? Seriously, think about it. What's the one number that could reveal the true financial health of any commercial building on the planet? I'm not talking about the flashy sale price or the crazy high rents you might hear about. No, I'm talking about the number that cuts through all the noise and tells you how a property is really doing. And that number is net operating income, or as you'll hear it all the time, NOI.
So what exactly is this thing? The best way I found to think about NOI is this. It's basically the annual salary of a property. It's the money the building actually earns for its owner in a year, just from its own day-to-day operations. Simple as that. Okay, so here's the more official definition. NOI is the property's total income minus all of its regular day-to-day operating costs. But, and this is the really important part, it's before you pay the mortgage and before you pay for any major improvements or upgrades. That little distinction right there, that's the secret sauce. That's what gives this number all its power. All right, let's actually build this number from the ground up. It's not super complicated, I promise, but every single piece tells you part of the story about how healthy that property really is. First up, we need to figure out something called effective gross income, or EGI. So you start with the absolute maximum amount of money the building could possibly make. If it was 100% full, every tenant paying on time. That's your potential rental income, plus any other cash coming in from things like parking spots or laundry machines. But we all know that's not realistic, right? So from that perfect world number, you have to subtract the money you'll likely lose from empty apartments or tenants who don't pay. And what's left over? That's your EGI. It's the money you actually, realistically collect. Okay, next up, we've got the expenses. We have to account for all the day-to-day costs of just running the place. We call these operating expenses, or OpEx for short, and this is all the usual stuff you'd expect. Property taxes, insurance, fees for the property manager, any utilities the owner pays for. Basic repairs and maintenance, landscaping, janitorial services, all that stuff. These are the costs you have to pay just to keep the lights on and the building operate. And that brings us to the final, beautiful, simple formula. You just take that income you actually collected, your EGI, and you subtract all those day-to-day operating expenses we just talked about. And bam, the number that's left over, that is your net operating income. That's it. It's the property's pure profit before you even think about the mortgage or any big-ticket renovation projects. But here's a twist. What's not in the formula is just as important as what is. I like to think of it as a kind of VIP club of expenses. They're intentionally left out of the calculation. And there's a really, really good reason why. So check this out. While all those routine costs are in, some of the biggest checks and owner rights are left out on purpose. We're talking about the mortgage payment. That's out. Major upgrades like a brand new roof. We call those capital expenditures. They're out too. Even the owner's personal income taxes. Nope, not included. And this is why it's so critical. By yanking the owner's specific loan details and their personal tax situation out of the equation, NOI gives us this pure, unbiased look at the performance of the property itself. It lets you compare two different buildings on a level playing field. It's a true apples-to-apples comparison. Okay, so we get it. We know how to calculate it. But why do investors and lenders and real estate brokers, why do they obsess over this one number so much? Well, it's because NOI isn't just a number on a spreadsheet. It's the key that unlocks almost every major financial decision in real estate. So, there are really three main ways NOI gets put to work. Number one, it's used to figure out what a property is actually worth. Two, it's what the banks are going to look at to decide if they'll give you a loan. And three, it lets you make that true apples-to-apples comparison between totally different properties. Yeah, the most common way to value a commercial property is using something called the cap rate formula. It's simple. You just take the NOI and divide it by the capitalization rate or cap rate. Now, don't let that term scare you. Just think of the cap rate as what the market generally agrees is a fair return for a property like this, in this neighborhood. It's kind of like a benchmark for how profitable a building should be. Let's make this real. Say a building has an NOI of $500,000 a year, and the going cap rate in that market is 6%. Well, that property is valued at over $8.3 million. But here's the magic part. If you, as the owner, can find a way to increase that NOI, maybe by raising rents just a little or cutting some costs, you directly
and instantly increase the value of the entire property. It's a direct link, which is incredibly powerful.
And what about getting a loan? Well, banks live and die by NOI. They use it to calculate something called the debt service coverage ratio, or DSCR. All they do is they take the NOI and divide it by the total annual mortgage payments. What they're looking for, what they need to see, is a ratio of at least 1.2. What that means is the property is bringing in 20% more cash than it needs to cover the mortgage each year. That's their safety cushion. No cushion, no loan. Of course, in the real world, NOI doesn't look the same for every building. It behaves really differently depending on the type of property you're looking at. The numbers for a big apartment complex are going to look totally different from, say, a giant warehouse.
And this chart really shows you what I mean. If you look at retail or industrial properties, a lot of times they have what are called triple net leases. It's just a fancy way of saying the tenant pays for the property taxes, the insurance, and the maintenance. See how that shifts a ton of the expenses off the landlord's plate? And that results in a really high NOI margin, often 75–80% or more. Now, compare that to a multi-family apartment building, where the landlord is on the hook for a lot more of those costs. Naturally, that leads to a lower NOI margin. Now, a word of caution. When you're calculating NOI, it's actually pretty easy to make mistakes that can give you a dangerously optimistic number. A really common one is using the advertised asking rent instead of what places are actually renting for in the area. Another big one is underestimating how many units will be empty, or, and this is a sneaky one, misclassifying a huge expense like a new roof as just a routine repair. That can artificially inflate your NOI and get you into a lot of trouble. So, when it all comes down to it, what's the bottom line? It's this. Net operating income is the absolute bedrock of real estate analysis. It's the one metric that cuts through all the noise, all the different loans and unique tax situations to give you one pure, simple, unvarnished number that answers the most important question. How well is this property actually performing as a business? Once you master NOI, you have this incredibly powerful lens to look at any property. So the next time you walk by a commercial building, you can ask the real question. You can calculate its salary, but what story is that paycheck really telling you? What does it say about the building's health, its management, and its future?